Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. Remember, like, subscribe, comment. We want to get this all over the place. Okay, stocks remained pretty weak yesterday, following on from Friday's move on that strong non-farms print, and even higher bond yields. So bond yields continue to push higher. Only the defensive sectors were really in the green yesterday. Tech and cyclicals getting hit. Europe also joining in on the sell-off, down pretty heavy, 1.5%-ish. And then we had China also down again. Metals stabilized. Obviously, they had a big knee-jerk lower on Friday. So gold managing to stay green, but not really a material bounce. And then copper softening, but not breaking through that $4 level. So stability coming back in the metals for now. And then oil actually rebounding somewhat, up a couple of percent. Nat gas also bouncing. So basically that there was on the back of OPEC saying that they raised their outlook for oil demand out of China. In terms of volatility, strong bid coming back, particularly in Europe. We had been saying that European vols did look a bit low in that 13 handle that they had reset lower after central bank meetings last week. And then now that things have started to move again, arguably people seeing that vol as just too damn cheap, and therefore we see here up best part of 2 vols. So carry wise, negative carry in US indices. Obviously, they've been moving around a bit more. We still do see some positive carry in Europe, but that's not, that's reducing fast, sort of by the day. So here, but we've got very positive carry coming out of Nikkei, 70%. Realized really dropped off a cliff at 5 vols there, where Nikkei levels just seem to be kind of chopping around unchanged, not really doing a lot, while dollar yen has been trickling back higher up towards 132. So I don't know if that's building up for a move. I don't really think a 5 vols necessarily sustainable on Nikkei, but right now it's screening as the best short gamma you've ever seen. If we look at commodities, gold obviously in negative, it flipped there with the big move down. It has reduced though because implied vols caught a bit of a bid in gold, up 0.8 there, which is a significant move for gold vol. But then we still got positive carry across a lot of the commodities, likes of copper, likes of oil, still looking like there's some juice there for the gamma sellers. And even nat gas has got 22% positive carry, realizing 73 versus implied of 90. But clearly, as you guys know, that's certainly one for the brave if you're going to sell nat gas gamma. If we look at skew though, equity skew's catching a bit of a bid there. Downside tail risk kind of demand coming back as markets were looking a bit less bullish than they were, say, a week or two ago. So maybe some people kind of starting to worry a bit more about the downside, because if they put money back into the market, as we said, that you can see there's a reason for skew to go bid when you put money back into the market. If everyone's underweight and doesn't own it, there's no reason for skew to go bid. So if we're starting to see skew bid when the market rallies, and then when the market pulls back, skew bid as well, it's basically confirming the idea that people have put money back to work, and they now look at this thing that, okay, if the dollar continues ripping higher, we're going to go through a period of weakness. We want to potentially protect against that. Even though we want to hold equities for the longer term, we may have these near-term catalysts that could trigger a bit of a pullback. So that's the kind of motivation why people might want to buy some downside and buy some skew. Okay, moving on. So recession. So it does seem like the market's kind of had a bit of a move off this stronger data and decided that maybe recession isn't happening, or if it is happening, it's not going to be as deep, right? So the big surprise, obviously, Goldman's are calling their recession probability down as well. Non-farm payrolls obviously has been, but it has been questioned for some time due to these census and population adjustments and this large divergence between the household survey and the non-farm payrolls. So jobless claims have also not spiked, which has basically been saying that the labor market is tight. But we also think that's likely due to the fact that job cuts are in the skilled workforce, right? All these tech layoffs that we're seeing are in the more skilled part of the workforce, and the jobs that are being added are in the more unskilled part of the workforce, right? That was basically jobs that didn't exist during COVID, okay, and now do certainly exist again. Okay, so there's this kind of polarization in the workforce of the different types of workers that we have. And bear in mind that tech employees, when they get laid off, they get pretty healthy severance packages, which doesn't mean they go straight out the door looking for support. So the jobless claims are going to have a lag. If those people don't get back into the workforce, then maybe they're going to claim. But right here, right now, in the latest round of job cuts that we've had across the tech space, there's a lag there, and that's maybe why we're not seeing it. Now, what we are seeing is the challenger job cuts numbers moving quite dramatically. This is from Tier 1 Alpha, this inverted curve versus non-farm payrolls in red, and the challenger job cuts number inverted in green. And generally, these things track each other fairly nicely. The job cuts may well be a bit of a leader to some of the bigger moves in non-farm, but these things are diverging massively. Okay, so just worth bearing in mind that we've got an earnings outlook that's deteriorating. Right, Mike Wilson's been banging his bearish drum again, talking about forward EPX growth has turned negative. That's the fifth time only since 2000. History shows that price downside is in front of us, not behind us. So he's calling for those negative EPS revisions to lead the market lower and take us into a earnings recession and an actual recession. Obviously, if there's a credit cycle downturn, we are likely to see that as well whenever it comes. And some of these jobs numbers are suggesting that they are very, very lagged. Okay, so I would take the non-farm spike with a bit of pinch of salt on the back of all this other stuff that we're seeing. All the leading indicators for the economy are still very much pointing the way down. And so, I think it's a bit, this number, I'm kind of leaning on it less. Now, the fact that the Fed put so much importance on this number is surprising. And we're going to just have to wait and see if they're going to wake up to that and change their methodology ever at some point. Now, we don't deny that the rollover that's expected in the labor market has been delayed. Household survey also showed a bit of strength. But we do think the market was a bit too quick to do a U-turn on the recession scenario, given the lags to monetary policy tightening that we saw last year, and that could really give us a nasty shock to the economy at some point when those impacts feed through. I mean, if we take the UK, where I am, for example, right, when with the current mortgage rates being above 5% now, and these things were at 1.5% 2 years ago, right? People who have got fixed terms that are ending now, 2-year fixed rates that are maturing, and they need to, reset their mortgage rate. Their mortgage payment is going to triple, right? Their monthly mortgage payment is going to triple. And we've had higher energy costs, we've had higher food prices, and now all of a sudden my mortgage is tripled in cost, right? So that is inevitably going to hurt demand. And whilst in the US there's longer mortgages, and so that they won't necessarily feel that impact, just in general, higher rates will feed through to the economy in a number of ways. And when they do, and these refinancings all hit, whether it's in the corporate sector or the private sector, then I think we've got a bit of a shocker coming, basically, right? So that's something we need to be aware of, and hasn't disappeared just because you've got a high non-farms print, basically, right? So that's kind of what I'm thinking right now. In terms of trade opportunities and things like that, the rates repricing has been pretty dramatic. So clearly this is from the Fed Watch tool. The pricing for the March meeting has now gone to 100% for 25 bips, and maybe even a small probability of a 50 bip hike in March. That's what the market's pricing. If we look at the SOFR futures, and this is the transition from LIBOR over to SOFR, that's how people trade like the short end of the curve now in terms of interest rates. So those have dropped by 60 basis points, from their local high. So it's effectively 2 rate cuts that have been priced back out of the curve, right? So, the market was pricing in a lot of rate cuts starting sometime middle of this year and going into the end of next year. And we've just taken 2 of those cuts completely out because of the data that we've been seeing. Okay. So the current implied level for rates in those June 24 SOFR futures is around 375. And the current SOFR futures is pricing, today's one is pricing at around 1% above that, 100 basis points above that. So basically what we're saying is by next summer, the market is pricing rates, whether rates go up or not, from here, we're going to be 100 basis points lower in rates. Okay. And if we were to get a full-blown recession, arguably that's not a big enough number, right? So in a full-blown recession, if you historically look at what the cutting cycle and how dramatic and how quick it's been, you shouldn't be really surprised to see rates go back to 2%. Obviously, we've seen them go to 0 before, but if rates go back to 2%, that means rates are just equal to the inflation target rate of 2%, basically. So 2% move back down in rates in the face of a full-blown recession doesn't sound ridiculously crazy to us. So how could we trade that? So if you look at the options on the SOFR futures, right, and these are tradable for retail as well. They're on the CME, these futures. So I've just given a snapshot here of Bloomberg to show you what those SOFR futures look like. All right, that's it for today. Thanks a lot for listening, everyone. I'll catch you all tomorrow.